Hi guys, and welcome to the second part of the pattern series. In this session, I'm going to talk about the triangle patterns. Most of you should already know about these triangles, but there's a lot to learn about patterns that you don't learn in textbooks and in basic TA courses, because most resources focus on the absolute basics. They tell you how to interpret a pattern by default. And this is, in my opinion, a mistake. What I want to try to achieve with this course is to give you a deep understanding of patterns and not just to tell you what 100 books and 1,000 videos already told you, that a symmetrical triangle is a continuation pattern. And when you are coming from the top and we see a symmetrical triangle, it will continue lower with a measured move, all of this stuff. I'm not going to talk about this. This is something that you can read up everywhere, literally in all basic TA resources. There's a chapter on how to read patterns by default. But I'm not going to talk about this. I'm going to talk about how to read, how to interpret price action. The main issue with patterns is that when you're learning TA and someone tells you, look for triangle, look for a symmetrical, or look for a rising wedge. Look for a rising wedge. When you see prices in a rising wedge, it's bearish, we will break down. This is something that, yeah, I can understand that complexity must be reduced to learn something. You start off by learning the basics and the easy stuff, and you get rid of everything that is unnecessarily complex so that you get a basic understanding. But when you try to advance and when you try to become better and improve in TA, and you want to really understand what is going on, and you really want to be adaptable, then you have to get rid of this cage you've been put into. Because these basic resources tell you something and with the only purpose of reducing complexity and giving you something easy to work with. But in trading, and as well as in life in general, there's a trade-off. When you intentionally go for simplicity, it means that you get rid of reliability. Because the easier something is, the less aligned it is with reality. Reality is complex, and you can, of course, simplify things and be very, very accurate and very close to the reality in this case. But in price action and trading, I feel like there comes a point for traders and analysts at which it is important to get rid of this cage, these restrictions, and to start really understanding what price action is, how it works. And patterns are a simplification of price action. They group certain candles or lines or whatever chart you're using, but I stick to candlestick charts. Then as you can see, they group a number of candlesticks together. And by doing this, the pattern has some default interpretation, some default meaning that you can rely on. So you don't have to think for yourself. You don't have to look at the candles and think, oh, what's going on here? Is this bearish or bullish? And what's happening here? You don't have to dissect this trading range. You don't have to look at each candle and think of what is happening there. This is what a pattern is. A pattern is a simplification of price action by grouping candlesticks together to tell you something by default. And if you choose to go that way, you have to keep in mind that this is a risky approach. You can be wrong. This is because at this point, when you trade based on pattern recognition, as I explained in my last session, when you just look for a pattern based on visual appearance, and for example, you see this kind of sequence of the rising wedge you see on this chart here. You see this kind of formation here. And you immediately think, because your brain jumps on it and it immediately recognizes the rising wedge structure here. So the first thing that comes to mind is it's bearish. It could reverse at some point here. This is because you're conditioned to think that, you're trained to think that. It is a mechanic that helps you managing complexity. If you follow these heuristics and these simplifications, of course, life in trading and TA can become a lot easier, and it's a good thing. I don't say that. I'm not saying that simplicity is bad. Not at all. It is important because you can't invest all the time in cognitive resources to cope with all this stuff, to get deeper into each and every candle and analyze what's happening there. No, this is not something you can do. So you have to simplify, and patterns are an excellent way to do that. However, I just want to make you aware of the fact that this is a simplification. It's like a model, and a model has downsides, and the downsides of patterns as well as models are that they don't accurately describe the reality because they are simplified. So what we have to do in order to get to an understanding of what is actually happening in a pattern and why a pattern is a pattern and why some smart guy 100 years ago told us that a rising wedge is bearish, if we want to come to the realization why this is the case, we have to get deeper into this. And we have to break up this cage, the predefined mechanics, and we have to see what hides behind the curtains here. And this is what I'm going to do with these sessions. There's a lot to learn about patterns. I'm not a pattern specialist, but I feel like I have a good understanding of why patterns are patterns, why they exist, why they play out like they do, what the risks and chances are. So I just want to share this experience I have. But I'm by no means an expert. So I'm sure there are traders who are very, very knowledgeable about patterns and have 100 different techniques on how to handle them. So if you want to dive deeper into this and get more perspectives on this topic, look around. I mean, this is very common. You will see a lot of traders, a lot of professionals trade based on patterns. And what I'm telling you today is my personal view, and you can enrich that and complement that by also listening to what others have to say. But I can tell you that it's like a jigsaw puzzle. This kind of the pattern landscape is like a jigsaw puzzle. If you put the pieces together and you understand pattern by pattern, and you start really understanding why price is moving like it is moving, because you really know what the patterns are about. You stop looking at patterns. You see price action for what it is, and the more pieces you gather to complete the puzzle, the more secure and confident you get in your trading and strategy building and in everything in TA and trading. So this is really worth looking into, even for beginners. If you're a beginner, if you're completely new and you haven't yet heard anything about the things mentioned on this slide here, not a problem. I mean, you could go ahead and look up the basic definitions of triangles before listening further to this session. But you can also start with this one and see how it turns out if you look at the basic definitions after you have heard my explanation. So yeah, let me know what you think. I mean, I'm really curious to see what you think about this. This is probably my most sophisticated session to date. And yeah, I just hope I get the structure right. And yeah, it could take a while. Okay, to start off, I would like to talk about the triangle star. I came up with this triangle star because I thought, hey, in price action, there are triangles in all directions. Why not making it some kind of fancy structure like this one? Yeah, it kind of helps in bringing all the pieces together when it comes to triangles. So the first thing I want to talk about with regards to triangles is they can be divided into pressure increasing triangles and pressure releasing triangles. Pressure in price action, I'm not sure if you know what that is. If not, I have a deep dive session on pressure zones. Watch this. I mean, it is very important to know this stuff because we are going to talk about pressure zones all the time now. And if you haven't yet watched the session on pressure zones, do so. It is very valuable. And it will help you understand what I'm about to talk about, what I'm going to talk about in the next minutes. So we have pressure increasing triangles. We have pressure releasing triangles. Pressure increasing means that we are entering a pressure zone, or we are already in a pressure zone that is becoming tighter, narrower. Support and resistance is pressing price into a very narrow trading range. It is happening in a falling wedge. It is happening in a symmetrical triangle. And it's also happening in a rising wedge. These are the three pressure increasing triangles. Then we have 5 pressure releasing triangles. The opposite to the rising and falling wedges are the descending and ascending broadening wedges. And as you can see, the volatility is increasing. The range is becoming unstable of some sorts. And the opposite of a symmetrical triangle is the broadening wedge. So you have, in this phase, you don't have increasing pressure, you have decreasing pressure. And decreasing pressure means that volatility is increasing. Whereas increasing pressure means volatility is decreasing. This is very important because we have to trade them very differently. They follow completely different rules in trading. And this is, if you know about these differences, you can manage your patterns, your triangle patterns much better. Then we have we have 2 outliers. We have the V-shapes, the V-shaped bottom, the V-shaped top. Of course, a top can look differently. These are just examples. We could also have an M-shaped top or a W bottom. This is just the triangle version of sorts. So a V-shape, of course, is a triangle, a V-shaped top as well. And these are also pressure releasing because the volatility is strong. It doesn't necessarily become stronger, but it is strong. So a strong volatility means pressure is being released, and there's no pressure zone that price is entering along the way while traveling through this V shape. All of these patterns have completely different meaning. If you look at, let's start with the simplest one, the easiest one. It's the symmetrical triangle. It's probably one of the first patterns you ever learn about or hear about when you look at a TA resource of your choice. The symmetrical triangle is something that you encounter very early in your journey. Yeah, this is one of the easiest patterns to handle as well. What does it show us? What does the price action on a symmetrical triangle show us? As you can see, we have bullish price action, we have bearish price action, we have bullish price action, we have bearish price action. So price action is balanced. We have both sides defending their support and resistance entities. So we have this bottom closing in, and this kind of trend line is being defended by bulls. But on the other hand, the trend line, the ceiling here of the structure, as you can see, this resistance entity is closing in as well, and bears are defending that one. So this is balanced, and price action is neutral. It means both forces are equally strong, and we don't yet know who will win this battle zone, who will prevail in this area. We don't know that here. And get rid of everything you've heard before in terms of it's a continuation pattern. This doesn't count now. We're talking about price action. This price action doesn't tell us anything about the direction this will break out to. This is neutral. And this is why it tells us there's indecision. Bulls and bears are both equally strong, so there's no decision on to which side, which direction is prioritized, or which is more likely to be the side of the breakout, where the breakout actually happens. I let this stand for now. I'm not going too deep into this. For now, we are going to talk about examples later and see what kind of different variance we can observe in real price action. But for now, it is important to keep in mind it is a neutral pattern, and it tells us there's indecision. Let's look at the rising wedge. It's also one. The rising and falling wedges are also patterns you encounter very early, very standard patterns to trade, and also one more easier to trade as well. The rising wedge shows us the trend is up. This is the first information. The trend is up. We have bullish moves. We have retracements with higher lows. We have bullish continuation and retracements. So this tells us what? First of all, price action is bullish. The trend is up. Bulls are clearly stronger than bears. This is very important. The second information we have is that, as you can see with the bottom trend line, is very steep. The incline is steeper, whereas the ceiling of the structure is not as steep. So there is a degressive development taking place here. We have stronger moves up, but then bulls are losing steam. They are becoming slower. The momentum on that move is coming. Yeah, it is turning. So there is pressure from above, as you can see with these rejections. You can see that there is pressure and sell-offs take place. So yeah, bulls have to catch these moves and have to bring price above the previous high, which is not easy to do because there's resistance here. Some will enter shorts here and take profits here because they fear this will reverse. So a lot of bulls will exit the market at this point, and bears will enter the market. So this is a point of risk. This will weaken price action. And as you can see, this trend becomes weaker. You can see this with the candle sizes. The trend becomes weaker, and yeah, at some point it's not strong enough, and bears are taking over. This is what a rising wedge can be. It is an uptrend. It is a bullish development. However, it tells us bears are trying to take over. They are trying to gain control of this area, and you can see this with a weakening bullish price action. This is what a rising wedge stands for, what it represents, weakening bullish price action. So this is why it is often considered a bearish pattern, or a pattern that leads to price action breaking it to the downside. This is what the default interpretation is. And in many cases, this also holds true. This means that a rising wedge often turns out to be a point of or structure that signals or that tells us a reversal is coming soon, or at least a retracement from this structure, from the resistance that is pressing price down here. So it is very important to keep in mind, rising wedge is not in itself bearish. It is, first of all, it tells us there's a bullish trend going on. So it's not bearish, it's a bullish trend. However, this bullish trend is becoming weaker. So the situation as of now is bullish, but the outlook is bearish or less bullish. And we have to keep an eye. During the time this rising wedge is playing out, we have to keep an eye on what is happening here. Is this weakness maintained? Can bulls recover? Can they become stronger again? Or are bears becoming stronger? And while this rising wedge is forming, we can observe how this is playing out, and we can estimate the chances of bears actually succeeding in gaining control of this area or not. This is how you can handle this. Someone who only has the knowledge from a standard book, for example, or some basic info chart and or I don't know, basic explanation, they automatically think that this will break down. This has a high chance of breaking down, and yeah, they go short. Whatever price is doing in a rising wedge doesn't matter. We go short, stop loss here, do some measure move, whatever. Yes, you can approach it like that, and it's not It's not necessarily a bad approach. However, it is a less effective approach than the one I'm going to teach you here. So this one is, we are going to really look at the stuff that's going on and to increase our chances to be right. Because we know what's happening here. We don't say, hey, this is a rising wedge, I'm going short. Independent of what price is doing here, I'm going short. No, this is not what we're going to do. We're going to find the rising wedges that actually break to the upside, because we know how to read this area. This is the edge that I'm going to teach you. When we look at a falling wedge, it's very similar. Just the opposite of the rising wedge. You can see that the overall price action is bearish. We have a bearish trend. We have lower lows, lower highs. So this is a bearish trend, a bearish development. However, it is increasingly turning bullish because the steam is running out. The incline, it's not that steep anymore. You can see that price is trying to find a bottom. It is bouncing from tiny lower lows already. So after making a lower low, price is already finding support again. This is a typical sign of accumulation-like price action. This means that bulls are buying each and every support level, and bears are not strong enough to drive price much lower. If we consider that there are liquidations taking place and stops getting triggered below this low, and price still keeps very near, it's actually, once it breaks this low, we expect a short squeeze, a long squeeze to take place, because longs get liquidated and triggered, stop losses are triggered, but it doesn't really happen. We have a new low made very close to the previous one. This tells us that buying pressure is compensating for this liquidation pressure that is coming in. And this tells us that bulls are trying to gain control. They are defending this area very well. This is why a falling wedge is often considered a bullish structure with higher chances to break to the upside. It makes sense because bulls are getting stronger, bears are getting weaker, but bears are still the stronger force in this structure. So what we have to look for is what is happening here. Exactly as with the rising wedge, we want to see, are bulls really getting stronger or not? Or are bears suddenly accelerating again, becoming stronger, and maybe this will break to the downside, because there are falling wedges that actually break to the downside as well. And you will have the ability to spot the rising and falling wedges that break in the contrarian direction as expected. Okay, this is it for the symmetrical triangle, the rising wedge and the falling wedge. The pressure increasing triangles. As you can see, all three of them have some kind of deadline until they have to break, because the trend lines or the support and resistance entities are converging. So at some point there's not enough space anymore for price to move at all. So we will see a breakout, and we can time this. We know exactly when the time is over and when there will be a decision. And this makes it very easy to trade these. The story is quite a bit different with the broadening wedges, because you don't have this don't have this narrowing trading range that ultimately is where the trend lines, for example, are crossing each other and the area is gone. There's no space anymore. In fact, in the case of broadening wedges, the area becomes, it's growing in size. So you don't really know when this structure will come to an end or when this will break. This makes it a little bit more difficult to trade these compared to the rising wedges, falling wedges, and symmetrical triangles. The second aspect why broadening wedges are a little bit more difficult to handle is the pressure release mechanic, because pressure release means volatility is increasing. And when volatility has taken place to one side, for example, in this broadening wedge, we see this sharp parabolic move to the upside, but the structure is still intact. So there is no breakout yet. But to enter along, you would wait for the break above this trend line to confirm there's a breakout taking place. But by then, a large portion of the move has already happened. and bull steam is gone to some degree, this is a problem, because usually you want to buy the bottoms and not the tops. So in these kind of structures, we have additional factors in the equation that makes it more difficult to handle this stuff with actual trades. So if you're starting out, I would suggest you look for pressure increasing triangles. And if you're advanced and you want to identify more trading opportunities, you can look for the broadening wedges. They are more difficult to handle, but they occur very often. So even also in bull market environments, we see broadening wedges all over the place. So it will open up a completely vast number of new trading opportunities that you can engage in, but you have to keep in mind the difficulty is higher. So let's briefly talk about each of these ascending broadening wedges. You can see the trend is up, but it is not a strong trend. You can see how the sell-offs retrace quite a bit, almost to the previous low. And this means, what does this, think about this for 1 minute. Let it get to your head. What is happening here when you see this kind of sequence, this price action? In this ascending broadening wedge, you see that bulls are maintaining an uptrend. But what is happening here? What do you see? You can pause the video, think about this for a minute, and then keep your answer in mind. This basically tells us that when we see sell-offs to the point of where the previous low was, very, very close to it, like a 764 Fibonacci retracement or an 8861. I don't know if you're familiar with the 886 Fibonacci retracement level, but this one is very popular in ascending broadening wedges. And you can observe that price often likes to retrace almost all the way down to the previous low. What this tells us is the fact that bulls are unable to hold the support levels. They are able to defend the previous low, yes, to maintain the uptrend. This is the strongest support they got, the previous low. They have to defend this to maintain the uptrend. However, they are unable to defend all the other support levels they have potentially gained by flipping resistance on the way up on these tiny rallies. This means that when you have price jumping higher here above this previous high, and price is finding support on this level for a brief moment, but then falling back down to the trend line, it means that bull power, buying pressure at this level, which should in fact be strong support now, is not strong enough for bulls to actually defend this area. This means there's weakness in this uptrend. Weakness. And it also tells us that the entire trading range, because this is a broadening wedge, is becoming unstable. You can see how the volatility is increasing and things are getting out of control. Support and resistance is being violated all over the place. Aggressive price action. This is something that, we see very often, very, very often in bull market environments especially. And it, first of all, based on facts, the price action is bullish because the trend is up and bulls are stronger than bears. However, it tells us bulls are becoming weaker because they can't defend their support levels anymore. And price is threatening the core support bulls have over and over again. So if you see something like this in an uptrend, it is usually a sign of a reversal soon. This is why an ascending broadening wedge is considered a bearish pattern that often breaks to the downside because bulls are showing weakness. However, there are cases when ascending broadening wedges break to the upside as well. And this is the same logic to the rising and falling wedges. I will explain to you why these things happen and how to identify broadening wedges that will break down and broadening wedges that will break up or have a higher chance to break up. We are always talking about chances, of course, and probabilities. And as I explained in my first part, patterns are, patterns never give you 100% reliability, nor does anything else in TA. But patterns are, yeah, a bit tricky in particular. So you always have to expect some failed trades, even if you read this carefully and know what's going on. It doesn't work out always, at all times. Okay, this descending broadening wedge. As you can see, bears are in control. They are driving price lower, and these lows are made with more power. As you can see, price is really digging down. So it's actually quite a strong trend to the downside. However, as you can see, with the volatility that is increasing, it's the same logic to the ascending broadening wedge, the range is becoming unstable. The bull force is still strong. And as you can see with the buybacks, it's the same logic to the ascending broadening wedge. The retracements go all the way up almost to the previous previous high. And this tells us there's weakness in this bearish trend. We have these significant lower lows and maybe even some really harsh dumping taking place in the structure. However, the retracements tell us a lot. And when you see bullish engulfings in this kind of pattern, it is also a warning sign that bulls might be taking over here. So this is something to look out for. Yeah, this kind of, if you see something like this, price makes a low, confirms the low, and shoots up, bullish engulfing at the bottom of the trend line. It is price action we see very often, it's not that difficult to read. But you have to carefully observe what is happening here. Bulls could all of a sudden become, at this point, when you see a bullish engulfing candle, very strong momentum, they could become weaker again all of a sudden, and then dump back down. This is also something that I'm going to show you. Okay, then we have the broadening wedges. You can see these are neutral patterns. Why are they neutral? Simply because, as you can see, price is making significant higher highs, but it is also making significant lower lows at the same time. So there's no real preference we have here at the moment. In general, this is more considered of a bullish pattern, but first of all, as with a symmetrical triangle, we have to keep in mind forces are balanced. It's neutral price action. We don't know where this will break based on this price action. So we don't interpret into something that someone else tells us based on probabilities. We're going to look at the price action. The price action tells us this is neutral. We don't know yet. If it breaks, okay, it breaks. But at the moment, we can't really say. So then we have the V-shape top. Let's talk about the V-shape top. I mean, there's not much to talk about with these one, and these will probably be not focused on the session. But as you can see, we have a strong uptrend, we have a reversal candle structure, and we have a sharp downtrend again, typical blow-off event. Very, very often in all time frames, bullish and bearish, of course. We have a bullish trend reversing to a bearish trend. There's not much to really read into this. What you want to look for is the momentum decreasing on the way, halfway maybe here, then you could have some kind of continuation up. So you want to look for strength and weakness on these moves, especially after candles that could indicate we have made a top or a bottom. Same is valid for the V-shaped bottom, as you see. Same story. Bearish trend, reversal, bullish engulfing here, for example. Some consolidation to add resistance to confirm support and then higher. Very typical for inverse head and shoulder structures, for example, as well, or despite the fact that inverse head and shoulders are usually not a clean V shape, but on the macro scale, they could. If you zoom out on an inverse head and shoulder, it will look like a V shape. So this would make sense. Same is valid for head and shoulder here, but yeah. Okay, so this is the triangle star. I hope this was helpful so far. If you have this down, if you know about this, and you can you know the characteristics and why each pattern is a pattern and what is happening there, as I explained just now, you're already far ahead from the majority of traders, because most traders rely on rising wedge, bearish, breakdown, falling wedge, bullish, break up, symmetrical triangle, continuation, and such. So, and remember, the vast majority of traders is losing money, and they all know about this pattern stuff, the basics of patterns that I just described. So this knowledge is not something that gives you an edge over the market. Knowing that a symmetrical triangle is a continuation pattern and rising wedges most probably break down is not enough to make you super successful. So what I want to try to convey and what I want to achieve is that you reach a level that, yeah, not many have. So you can actually really adapt on the fly. If you see a rising wedge in which bulls are becoming weaker and you are entering a short with a stop loss, very nice setup, and you suddenly see that bulls are becoming stronger and forming a mini parabolic structure in this rising wedge, holding the lows, or they may produce a failed breakout to the downside, get back into the structure, and you can act immediately because you know this weakness that is supposed to be here by bulls is being invalidated. You get out of your short, enter a long. So you can actually even long a rising wedge. You know when to do this. This is valuable. This is what makes you adaptable. You can act on changing circumstances. And this is a skill that I found to be extremely valuable, and not just the knowledge about, the basic stuff. Okay, I'm going to split this here. We will go into specific examples of triangle patterns in the next session. I don't want to make a 4-hour session because probably nobody will probably watch this because it's so long. So I will break this up. This is the first part, the triangle star. The second part of the triangle session will be specific examples, and the third part will be about transformation of patterns. So this will go very deep. We have just scratched the surface. And we are going to talk about super interesting stuff. And you will see patterns from triangles, in this case, triangles from a completely different perspective than before. I can promise you that. And the plan is, after the triangles are done, we're going to talk about other patterns, because there are a lot more. We're also going to talk about head and shoulders, cup and handles, what is there? Channels, U and M shapes and W shapes and whatever. I mean, there are plenty patterns to discuss, and I think it's worth doing this because patterns are one of the best opportunities you get to get high reliability trades. Okay, so this is it for the triangle star, and see you in the next session.